So thank you again for joining us this morning, where John Dunlop and I will run through understanding employee ownership trusts for you all. As John just said, any questions, please drop them into the Q&A part of the Zoom thing, and we will hopefully get to them during the show. So I'll let John introduce himself.
Hello, I'm John. The short summary is I'm John, I do tax. There's more words there.
And John is partner at Marriott Harrison, and that's me. I'm Tom Adcock. I'm a tax partner here at Gravita. Just a quick thing on Gravita. So we are, if you don't know us already, we are fairly new to market. We've only been around 2.5 years or so, but that's because we're a consolidator. So a number of reasonable sized firms have all come together to form us. We're 500 or so people, 50 or something partners. With our largest office in London, but we have offices in the southwest, in Exeter and Bristol, one in Oxford, and an office in Ilford as well. And we do all the things that good accountants do. So from audit, accounts to tax advice, and of course doing your tax returns, which are coming up soon. So that's us. And as a member of our international network, DFK, we support our clients as they navigate not just the UK but also overseas tax environments. And John, I want to touch on Marriott Harrison, your new home.
Marriott Harrison's my new home. It's not quite the strapline, but it's a law firm, and I think of it as it's got corporate at its heart. It's essentially a lovely place full of lovely people doing wonderful work, all in connection with buying and selling companies, investing into companies, and all the bits that just sitting around outside of that. So I've been there 6 months, and they all seem to be really lovely and nice and fabulous work with great clients. So still the honeymoon period, clearly.
And I think some people might be confused as to why we're doing this jointly. But the reason for that is simply because when it comes down to EOTs, it's you both need an accountant and you need a lawyer to affect what you're trying to achieve. And so John and I work closely together on, well, not just EOTs, many other things indeed, but certainly with employee ownership trusts. So.
And we get on well.
And we do get on well, which is always good to know. So, right, John.
Right. So this is the picture that we're going to talk our way through. When you look at it to begin with, it looks a little bit daunting. So what we're going to do is we're going to break it down into its constituent parts. So at the moment, that probably looks a bit daunting. But what we're going to do is we'll start off with that, take it back to the core, and then we're going to show you that at the end, and you'll now understand exactly what is going on there. So what you've got is we're going to imagine, for the sake of simplicity, that you've got two founders and they've got a holding company with 3 subsidiaries. You don't need a holding company with 3 subsidiaries, but it just looked a little bit lonely when on the slide when you had just one company. So that's why we put the subs there. So there we go. You've got that. And for those of you who want to have a look at the words afterwards, there's some words here. We'll talk about those. So the first thing we're going to do in this story is we're going to create an employee ownership trust. That is, in effect, just a piece of paper. That is, as the name suggests, it's a trust that's set up for the employees, and it will own something. So what is it going to own? We'll come to that in a minute. Who are the beneficiaries? The beneficiaries are essentially the employees. There's some narrowing of that as we come along, but if you just think of that for the simplicity until we get to the detail, that is just the employees of that combined holding group. Okay, so what we've got is the sale, because what we're going to do is we're going to be selling that holding company and therefore the subsidiaries. It's got to be of a controlling interest of the group. And so what we're going to do is we will have a simple document, we'll talk about that in a minute, that sells the holding company from those 2 founders to the employee ownership trust. Because it's got to be more than 50%, the maths will get a little bit tricky. So what we're going to do is, for simplicity throughout the rest, we're just going to assume that it's a 100% sale, but it's very rarely a 100% sale. Okay. So there's some documents that we're going to need, and they're sort of a mixture of lawyer documents and accounting and valuation type documents, and they all have special elements included in those. We've talked about the trust deed, because you've got to have that piece of paper, and that actually forms the trust. And then you've got that sale and purchase agreement. So those are the first 2, and we shall talk about the others as we go along. Okay, so what we've got, if we went back to the page here, so what we're going to be doing is we're going to be selling the company to the employee ownership trust. A number of bad things happen if that trust if that trust pays more than the market value for those shares. I don't know, Tom, at this point, do you want to talk about valuation issues, or should we?
Well, you said it later on, but I think it's a very important point. Valuing the company and the group at the time which you sell it to the employee ownership is really important. The tax rules only work to the benefit of the founders and everybody else if market value is paid. It's a connected party transaction, so it has to be market value. And of course, usually market value is set by the third party buyer because you have a negotiation over the price you're selling the thing for. But in these circumstances, you are in effect the buyer, and therefore HMRC require you to consider the valuation very carefully. And we'll touch a little bit more on that a bit later.
Absolutely. So let's pick a number. It's always easier to think of these things in practice. So let's imagine that the two founders sell their business, that holding company. Let's go for the nice round £10 million. So they sell their business, they do the SPA, the sale and purchase agreement. We're still assuming 100%. They sell it for £10 million. So where does this employee ownership trust, the thing that we created with bits of paper, where does it actually get that £10 million from? Because it doesn't have any assets other than its seed capital, which will have been £100. And so what happens here is that the holding company stroke subsidiaries, they make a capital contribution, which you can see up there on the right-hand side. And they make a capital contribution. Where does that come from? It comes from the profits of the holding company subsidiaries, but after paying corporation tax. Okay, so the money goes up to the EOT. So what does the EOT then do with it? So if you're eagle-eyed, you'll have noticed that earlier on in that slide when we talked about the documents, it says that there are loan notes for one of those documents. So what is a loan note? Tom, what's a loan note?
That's a great question. So a loan note is a security, right? To be very boring about it, but in essence, it's a IOU. So the employee ownership trust is saying to founder one and founder two, we owe you £10 million. And it may have security in it. It may have a coupon on it or interest on it to pay the founders for the time value of the money, on which they'll pay tax on if they have the interest. But it sets out the rules of the game. So when the loan note should be redeemed, and typically, straight line basis, in a £10 million deal over 10 years, £1 million a year, something like that. And you redeem those loan notes as you go. In other types of tax situations, and we haven't mentioned it yet, in other types of tax situations, we use vendor loan notes to hide the gain that's been triggered on the sale of the company. So you only pay the tax when you redeem the loan note, when you get the cash. So that's how we use them usually. In this circumstance, we're not using it necessarily to defer any tax liability, although it could be helpful should the structure fail for whatever reason, and we'll come on to those in the future. But they are still part of the planning in order to ensure that everybody knows where they are and there's security for the sellers when they sell their interest.
So far in the story, the EOTs effectively borrowed £10 million through those loan notes, the IOU, and you see at the top there it says the part redemption of the vendor loan notes. And that's a fancy lawyer and accountancy word of saying we started off at 10, they'll give you the first million. You normally end up with the first million being paid on day one because there's a little bit of cash in the business. But you, as Tom said, you broadly just pay off £1 million a year. It depends on what the profitability actually the companies are. But if you Google any research on this, you will see that these types of companies, they get great employee engagement, which is one of the very big reasons to do this. So you can expect, or you can hope, that because of that employee engagement, the profits go up year on year. And so instead of taking 10 years, it takes less. Yeah.
So you'll see in our final slide, it says, I think, 7 or 8 years. So you pay off those loan notes. So you start off with 10, and they go down 9, 8, etc. You can, and we touch on this later on, you can borrow money. So the employee ownership trust can borrow money from, it's generally not a high street bank. It's normally an alternative lender. They're charging relatively high-ish rates of interest for what, compared to what you might expect for compared to your mortgage. But it's perceived to be a riskier
loan. So the interest rates are normally ticking around about, give or take, 10%. So you can borrow the money. Very few of these deals are bank financed or alternative lender financed, but some of them. And the bank will normally lend about a third. So if they do, then they would, the first 3 million will be paid off on day one. Okay. So there we go. So we now quickly wind the clock forward, well, 7, 8 years, something like that. And you will see that the employee ownership trust is now sitting there without any reference to the founders. That's because the founders have all been paid off. And once the founders have been paid off, then they extract themselves from the system and they're no longer there. So what happens to all the money? The holding company is making profit. And then you look to the clue is in the name. This is an employee ownership trust. What happens to the profit? The profit is there held for the benefit of the employees. And the very simplistic way of looking at it is all of those employees are entitled to collectively a share of those profits. It doesn't mean that all of those profits have to be distributed out to the employees, because the company and the board of directors can decide if it's a good thing to reinvest, it's a good thing to go out, if it's a factory, to go out and buy machinery, to invest in technology and AI and all those sort of things that they would otherwise normally do. But any surplus monies go to the employees. So that really is a quick whistle through of how it actually looks. The only thing we haven't touched on is there, Tom, if you can just address, because we talk about on the left-hand side, the UK company stroke partnership. What do we mean by that?
So those of you who've paid attention to the papers this morning and are involved in limited liability partnerships may be more concerned about something else with partnerships this morning than this. But this is available, this structure, using an EOT to transition the business from the founders, usually the founders, to the next generation who are going to be running the business going forward, is available not just to companies, but also to partnerships. So if you're a member of a partnership and you sell your interest in a partnership to an employee ownership trust, you get the same tax position as you would do if you were a shareholder in the company, assuming all the other conditions are met. And I think it's important to say, and just to make sure everyone is aware, one of the benefits for the founder, of course, they pay no tax. None.
Oh, very good point. Yes.
They pay absolutely no tax whatsoever when they sell their interest to an employee ownership trust. And that is the big driver from the sell side, as it were, in doing this. For the employee side, it's all about engagement. It's all about having some sort of ownership over the future of the business, being involved in the running of the company or the partnership going forward, and that sort of succession of the business going into the future. So, yeah.
So if you're a partnership, you can do this. If you're a company, you can do this. With a partnership, there's a few extra preliminary steps, but they can be done, and they can be done really behind the scenes, and they're not too troublesome, so they can all be done. And you will find, there you go, you get 7 or 8 years of profit, you get taken out tax-free. So we'll talk a little bit about why this is good, the advantages, the disadvantages, and the alternatives. But just focusing on the EOT for the moment, we talked about that consideration. So let's talk about, Tom, if you can talk about the funding of that consideration.
As John mentioned earlier, broadly speaking, it'll come initially out of the cash that's sitting on the balance sheet of the company. In John's example, there's £1 million worth of cash on the balance sheet that will get paid out day one to the sellers. So that's good. And again, no tax, important. And then over time, it's either going to have to come out of the future profits of the business, right? Or it's going to come from third-party investment into the company. So that would be a way of, say, loan from a bank. It might be investment from a third party who comes in to try and drive the business forward. It could be from existing people within the business injecting further cash into it. There are lots of ways of generating the money, but it can come from anywhere as long as it's in the company's hands to start off with. And importantly, if it's done properly, when the cash moves from the company through the trust to the hands of the vendors, there won't be any tax considerations along the journey. So no tax in the trust, no tax when it comes out to the vendors because they've met all the conditions for being an EOT. So the only issue will be the cost of borrowing the money. And as John mentioned, 10% for a third of the cash is, broadly speaking, about where we see the market at the moment. And of course, massively dependent on the nature of the business, but that's typically what it is. So that's how usually it is funded. And again, the reason we use the loan notes is to just create certainty in the hands of the people selling it. You know, they're selling their thing, they're selling it for £10 million, which is a lot of money. They're not selling it to a third party, they're selling it effectively to their team that are taking the business forward. And they just want some clarity and some certainty that what they are selling it for will actually get paid at some point in the future. So those loan notes are very useful. But they're also useful if the EOT fails, as I mentioned earlier, because we can use them to defer the gain should a gain actually arise that would be taxable, which is a fairly useful fallback position. Right. So as John was mentioning as we went through, one of the most important things is that an EOT can only be used for a trading business. It cannot be used for an investment business. Now, there's decades and decades and decades of case law as to what means a trade as opposed to what is an investment. Unsurprisingly, a business that owns a property which just rents that property out is not a trader. But a business that builds properties and sells them probably is. And so over those decades of case law, some pretty sort of rule of thumb standard positions have been taken. And they are on the left-hand side of the screen. So the 80-20 rule. Broadly speaking, if 80% of your turnover, 80% of your expenditure, and 80% of your gross assets relate to the trade, the factory that's generating, the widgets that you're selling, or the software that you're developing and selling, and the people you're using to do all the R&D. If 80% of that of your turnover, expenditure, and gross assets relates to that activity, then you'll be seen as a trade. It's not at the end of the world, right? It's not fatal if one of those tests are not met. So, for example, you might have a significant amount of cash sitting on your balance sheet, and that could be the gross asset test failed. In those circumstances, you have to argue, well, what is that cash being held for? Is it being held because it's retained profits and we just don't want to pay the tax, take the money out? Or is it being held for something else? For example, developing the business further, investing in, maybe in new tech, or buying another business in order to expand your reach. Those things need to be considered, but it's not fatal. And then the final test isn't really an 80-20 test at all. It's in the round. If I was standing on the street and I looked at the front of the building which housed this business, what would I think? Do I think it is a business? Do I think it's a trading business? Do I think it's an investment business? What's the look and feel of it over a period of time? What is this thing? Because businesses do change from time to time. We've got a company that we're working with at the moment that today they are a property developer. That's what they do. They buy large plots of land, they build things and they sell them. But way back in the past, they used to sell car parts. Neons, if you believe that, for the bottom of for underneath cars when those things were still legal in this country, and when we still had fun in our lives. And but because they're now in a situation where the property developers, unsurprisingly, you can't always sell all your stock, so they have to rent it out, and that means renting a property out is usually seen as an investment business, and so they have this weird little world they're in now. But if you look at the businesses around, it's always had a trading intent, so you can use the past sometimes to support the future. So that is trading versus investment. It is really important. And unfortunately, these things are still not settled. We are seeing more and more argument, conflict with HMRC over the positions that are taken on trading versus investment. And so it's well worth considering that before you go into any kind of transaction.
Yeah. I mean, I see it as the cash is often the key issue. Mm-hmm. And it's always quite helpful as you go along to decide. It's probably a good thing for a board to decide as well. What are we going to do with that cash? Why is it there? What do we need it for? Why are we not distributing it? Why are we holding it? And that can be across various different sectors, as Tom's alluded to and mentioned, lots of different opportunities for that cash. And in an uncertain world, in an uncertain climate, cash is a useful thing to have knocking around.
You're right.
So here we go. So we talked about now ownership by the EOT. So once all of the profits have been used to pay off that EOT, we then said we're now going to start to actually look at how we're going to distribute those out. But pausing just for a second is what happens in that interim period, because we talked about those legal documents, what's going to happen before we get to this stage when all the profits are distributed out. And what it's quite useful to think of is the balance of risk and responsibilities between the EOT and the founders. Tom's talked about the loan notes and why we've got those loan notes. If it's a 100% sale, then effectively that is the only document that the founders have got, which they can rely on to demand their money. Most people, even though we said for simplicity, just to make the maths work, most people prefer to have a not 100% sale. They prefer to keep an emotional part of the business. I'm seeing it in the range 65 to 80. What are you seeing, Tom? 65 to 80 is sold.
Yes, I mean, probably actually even more than that. I think the retention we tend to see is about 5-10%.
Okay. Yeah. So somewhere in there, 5, 10, 20% is retained. And so what you've got is you then have a shareholders agreement, because the founders are shareholders in the holding company in our story, and the EOT is as a shareholder in there, and that shareholders agreement governs the relationship between those. And it will continue even after those loan notes are paid off, that governing relationship between them. And you'll have a good set of articles as well to govern what actually goes on, because the articles are really a shareholders agreement by another name with a few extra whistles and bells. But once we've had, going back to the 100%, once we've had all of the money has been distributed out and the founders have exited stage left, as it were, how are you going to divide this out? There are a number of ways in which you can do this. The simplest way is to say, well, there's £1 million and there's, let's say, 10 employees. So £1 million divided by 10 is £100,000. Everyone gets £100,000. That would be very unusual and very rare. Most people, because where did the idea of an EOT come from? It echoed the John Lewis model. So what does John Lewis actually does? And what it does is it says, once you've satisfied your probation, everybody who is an employee of John Lewis, or to use their parlance, a partner, John Lewis or Waitrose, they get an annual bonus, and it is effectively a percentage of their salary. So if you look there on the right-hand side, an employee's remuneration, that is the first and one of the most popular ways in which you divide it out. You say we've got a pot to divide out, and we work it out, and everyone gets the same percentage of their salary of that pot until the pot is used up. You can also factor in their length of service, or if they're full-time or if they're part-time. But personally, I think it's a little bit harsh if you look at the remuneration and full-time, part-time, because obviously most people who work part-time earn less than the people who work full-time. And then you've got the satisfying the probation period of their first year. So that's really the ownership by an EOT and how you distribute that money out to the staff.
Importantly, of course, they get part of it tax-free, don't they?
Absolutely. Interesting, it's very relevant today. It's free of income tax for the first £3,600 per person per year, but it has to be an EOT bonus. It can't be just a regular, ordinary bonus. And there is, so we like to say all of this arrangement is tax-free, which is true, but there are two sort of taxes which you have to address here, because £3,600 carries national insurance, which is on the Times this morning, and also when you sell the business to the EOT, there is stamp duty. Stamp duty is only 0.5%, so it's normally lost in the roundings. But the employer's national insurance and the employee's national insurance is a big thing indeed.
Right, so timing, how long does this all take? So before we get to the bit at the top, let's talk about the bit at the bottom. So this is all about succession. An EOT is one of the devices that we can use in order to pass on the business to those that are coming behind us. And it's one of many ways of doing it. Right, there's trade sale, there's management buyout, and there's various different versions of those. And an EOT is the sort of the newish kid on the block that enables the business to be handed off to the next in line. But it has a slightly different feel to it because it is about all employees. So as John said, it's sort of mirroring or mimicking the government's understanding of the John Lewis Waitrose partnership model. It doesn't, but it's kind of what they're trying to achieve. So before any of these types of transactions take place, it's really important to spend 6 months talking about what it will look like, what the future should look like, at least 6 months. And that is an internal thing. When we work with our clients, and John works with his on that particular conversation, because if there is no appetite from the next in line to drive the business going forward, then a thing like an EOT probably won't work because there won't be the team there after the sale to the EOT to actually pay you as the founders the money. And that's something that needs to be thought about and considered. But there's the same with any kind of succession planning. Those conversations need to take place. So speak to the management, speak to the fellow directors who may be staying around, and actually, to be honest, speak to your client. It's quite important that they understand what might be happening to the future of the business. That the founders might be stepping away over a period of time, and a new team will be running into the future because nobody likes change a great deal. And it's helpful just to confront that and deal with that up front. And the other big driver and a big problem that we come across is regulatory problems, such as like the FCA. If you want to do a change of control with a FCA regulated business, it can take up to 6 months. So you need to be sort of aware of some of the challenges that you might have, lease arrangements, any kind of other stuff that you agreements with clients or with suppliers that may need to be moved around if there's a change of control of the business, particularly the bank. So how long does it really take once we've done all of that? Probably about 3 months. It will take 3 to 6 maybe, depending on the scale of the deal, the complexities behind it, whether there are things like share schemes and stuff in place. And as part of all of that, we need to also carry out a valuation, which we'll come to in a second. And that will typically take, on a normal sort of business, 2 to 4 weeks to pull together and get agreement, which then, of course, has to be agreed between the parties because you're effectively selling it to your to your employees. So, and a little bit of word of warning: EOTs are, because of the tax saving for the seller, they come with a lot of rules, and we're only really touching on a number of them here. There are disqualifying events. So if an EOT sells, so an EOT now owns all of the shares. In John's example, again, all of the shares. If we sell it within the first 5 years, all the capital gains tax relief that the sellers originally had is gone. It gets clawed back and they have to pay it. If it says after that point, the EOT effectively pays tax on the whole gain, right? The running capital gains tax rates at the time. So you need to be aware of these rules, and they do change from time to time. Mm-hmm. The government steps in and they change these things. Historically, we used to set the EOTs up, usually sometimes overseas. We can't do that anymore. And there are many other things that we used to be able to do that we can't do, but that is the world of tax. And so it's important that that the trustees that we end up running these EOT, which is typically the employees of the business, and sometimes jointly with the founders who sold their shares, that that they keep abreast of those changing rules and ensure that on a sort of annual basis they just check to make sure that either nothing they have done has potential to cause a problem, or that nothing has changed that they need to adapt to going forward.
But as Tom refers to there, there is the possibility that the EOT can sell that holding company. Mm-hmm. There is the possibility that unlikely, but the partners of John Lewis will collectively decide to sell John Lewis. It can be done. So we are starting to see now, because Tom said this is the new kid on the block, or the relative new kid on the block. It's been around 10 or 11 years. Yeah. There were very few in the first 3 or 4, but we're now starting to see that second level of choice. And it is possible for the EOT during the lifetime of those loan notes, or after those loan notes, to actually sell that holding company. And you've got the capital gains tax comments there, and there's other issues, but it is possible. This is not the end of the story. It can continue.
No. Yeah. Right. So we've sort of mentioned the word valuation a number of times. As I said earlier, it must be market value. Now, market value is sometimes, but it is important that it is considered in advance. Any excess may trigger income tax and breach the EOT regime and give rise to the trustees' breach of duties provisions. It is therefore really important that somebody values that company who is or business and is used to doing that. You have it. It's not enough to a back of a napkin in the pub one night just to say it's worth 10 million quid. You actually have to go through a process of valuing the business.
It used to be possible just about for the parties to come together and agree that valuation. Just about, and in certain circumstances, I think that was acceptable. Mm. That has stopped, and that has not been the position now for the last pretty much almost to the day year. So you have to bite the bullet and you have to get professional valuation. I'm chipping in here because I won't be the one doing the valuation. It'll be Tom's team.
Indeed.
But it's not a choice anymore. You have to get that valuation.
Absolutely. So that's a really important thing. And I don't know why it's appearing on this particular slide, anti-embarrassment clauses. So this is when we're talking about the EOT. So we get the valuation, we get it all done, we make sure we've got the right number, and we sell it to the EOT. Now, one of the biggest problems with valuations is that HMRC, with the exception of EMI schemes, which is an option arrangement, they won't clear the value in advance. So you can't write to HMRC in advance of a transaction and say, we valued this company at £10 million. Do you agree? Well, you can try it and they'll just ignore you. So what you can do, if you want to, is once you've carried out the transaction, you can then write to HMRC afterwards and ask for what's called a post-transaction valuation check. That is quite a useful tool, and we have used it from time to time. Of course, the argument goes, well, it's nice to have certainty, but equally, do I really want to raise my head above the parapet just for HMRC to take a shot at it? And I completely agree with both of those statements, despite the fact that they conflict each other quite nicely. But it is horses for courses, and we have that conversation and we decide based on risk as to which approach to take. Now, anti-embarrassment clauses, just as it should have really been on the previous slide, is when the EOT actually sells the company. It's perfectly possible, of course, that the trustees of the EOT might get a massive offer in year 2, and they're not going to turn the money down. Why would you? So they accept the offer, and what's quite important is that the original sellers, the founders, might want a piece of that additional amount of money. So they say, okay, in addition to selling my shares for £10 million, I also want to have a slice of any kind of future gain over a period of time, because I may have sold it for less than I should have done. And typically, an anti-embarrassment, that's what it is what it's called. And the sort of percentage is 75, 50, 25, nothing is what you see over a 4-year period. So the anti-embarrassment clause runs out over 4 years. It's just a bit of protection we see from time to time in deals.
But the only thing is, I'd say with that is, let's say, Tom, I mean, valuation is a range. It could be this, it could be that. Right. It's never going to go exactly 10 million on the dot. But for the sake of simplicity, imagine the valuation comes in and Tom's team says that it is exactly 10 million. And then you say, well, remember this anti-embarrassment. So we put in 10 million. Can you add that anti-embarrassment clause as well?
It would have changed the valuation, John. Well, potentially.
It doesn't change the valuation of the business, but if you're paying £10 million plus an anti-embarrassment, the anti-embarrassment must have a value, so the 10 million has to go down a bit. How much to be discussed, but it can't be 10 million plus something else, because then that's more than 10.
Indeed. So there we go. Right, process.
So we've talked about a lot of this as we've gone along. So the process is, as I say, Tom's talked about the timing of that. There's some tax clearances, so there's a tax clearance which needs to be done, which will not affect the time frame. You will issue those loan notes. You could have the 10% coupon alternatively. And the loan notes do actually have a 10% interest, or can have up to a 10% interest, which compares to what private equity are actually selling or actually charging. So it can all be done in a very straightforward manner. The loan notes are issued and everybody walks away, and it can be done relatively straightforwardly. There are a number of traps that we need to address in the various different documentation. So Tom's talked about what happens if there's capital gains tax, who's going to be funding that. I talked about the shareholders agreement. Are there going to be some reserved matters? Reserved matter says the minority won't let you, the majority, do various different things. There is now a number of extra rules which have been introduced in the last budget. So that was budget the last year, 30th of October. And so one of those, Tom, I think you wanted to talk about as to what happens if people resign.
So yeah, thanks, John. The rules require you to have the trustees can't be the founders only. They have to be predominantly the employees, or at least third parties that are running the trust going forward. And what we have is a situation sometimes where if someone resigns or someone dies as one of the trustees, you can break that balance, and you can end up in a situation where completely by accident you end up breaching a particular rule. So in these trust deeds now, you have to include and should include clauses which protect against those sorts of problems. So if a particular class of person were to resign as a trustee, the trustee would ensure that the balance of who is the trustees in that particular situation won't breach the rules, because let's say one of the founders is there and that would break it, then they just get removed as a trustee or is suspended for a period of time.
For simplicity, imagine that the trustees are actual individuals, and what the rules now say, and have done for the last year, is that if you've got your two founders, and they're the only two people with any shares, then what you need to do is you would need to have 3 independent trustees. For a business of worth £10 million, that's quite a lot of people on that trust board doing not a lot, but still needing to maintain their trust duties. So what we would now see is, and I'll use the word faith, each of the founders have faith in each other, trying to avoid using the word trust. They've got faith in each other. So one of the founders would be a trustee, and you would then only need 2 independent trustees to bring that trust board down to something a little bit more sensible. Also, it would be extremely rare for you to actually have individuals as trustees of that trust. What you do is you would form a trust company, and those 3 people would own the shares or the membership interest in that trust company. They would be the trustee directors of that trust company. Gives them that extra layer of protection, and also from a trust law point of view, it makes the process of agreeing matters a lot more streamlined, that you don't need unanimity.
Indeed. So let's just quickly summarise the process. So first thing to do, speak to your team, work out whether they have appetite and interest in doing the thing that you have been doing for years, if you're the founder. Second thing, look at the value of the company. Make sure that everyone's aligned on what that actually is. You might think it's worth 10, but the employees are like, it's only worth 2. So and there's no budget on that. So have that conversation. Make sure you're where you need to be. The third thing is get the advice, and then go for clearance. If you want to go ahead with this, you must go to HMRC and get tax clearance. It takes 30 days. HMRC have to respond unless they've got queries, and take a bit longer. But the clearance process is fairly well streamlined. There's a lot of questions that have to be answered and asked, but it's a streamlined process. And then the fourth thing is, once everyone's happy, do it. And at that point, it's putting together the paperwork, the trustee, the loan notes, the SPA to sell the shares, and doing all that good stuff. Once that's all agreed and everyone's happy with the form and of the deal, then it's the transaction itself. Everyone signs a piece of paper, some stamp duty is paid, shares are transferred, and hopefully cash will end up in the hands of the founders who are walking away, and everyone goes out for a beer. And it's all very nice indeed. And going forward, follow the rules, make sure the trustees are in place, they do the meetings and all that kind of good stuff. So that's the sort of summarise of the process.
We're going to talk about your post-completion actions in just a second, but before we do, we're going to talk about the other alternatives to selling to an EOT. The EOT is a very good way to slowly transition to the next generation. It's not about the founders selling, going to the pub, and we all sit there and then the founders never go back into the business. It's a slow transition. What we find is you will see that the founders, they still have an interest in the business because they've probably got that 5 or 10%. They still care about the business, and they will still want to make sure that their baby succeeds. You will often see that they're looking to move down from a full-time role down to a relatively lesser role. So they may, over the first 5 years, go from 5, 4, 3, 2, 1, and slowly allow the next generation to step up. But it is not the only thing you should be doing or you should be considering. So the alternative things on the right-hand side that you can actually consider, whilst they're not very popular in terms of very few of them are happening right now, you can do an IPO, an initial public offering, which is a fancy way of saying you can list the shares on a stock market. At £10 million, the number we picked, you're probably too small to be listing on the stock market. You need to be quite a bit higher than that. Management buyout, that's an MBO, that can be done. The main problem with an MBO is, in stark contrast to what I've just said, Management need to find some money.
Mm-hmm.
For the £10 million, they would probably need to remortgage their houses, put £1 million or £2 million of their own money into the pot and borrow £8 million from a bank. Not very popular, does not happen very often. I like to think of the MBO as being rebadged into the EOT because it's an EOT as an MBO. But the real two alternatives you are looking at are selling to private equity or selling to trade. Selling to private equity, there's a whole massive industry in the UK of businesses who are interested in buying, running and turning and reselling other businesses. They may sell for more than, they may buy for more than the 10 million in totality, but you may not get all of that 10 million on day one. And to get the rest of your money, you will have to satisfy some challenging new masters. You can sell to trade, which is essentially find your competitor, find someone who is worth 100 million and sell your business to them for 10, so they become worth 110 plus some synergies. Can be very attractive, and is what I spent the first 15 years of my career doing. I still continue doing those because they are still very popular. But the thing about selling to trade is that normally comes with synergies, and you normally have to decide, why did I set up my business in the first place? Was it because I didn't want to be with that £100 million business? Are you happy with your business being in trade? I think it can be, if you get the right buyer, I think it can be fantastic. I think if you get the right private equity buyer, it can also be fantastic. And I've seen IPOs work brilliantly. So don't discount them, but understand exactly what you are looking at. And you've got the article there, which talks about them in a little bit more.
I wouldn't discount MBOs perhaps quite as quickly as John does. I've seen them work much more successfully, but they have to be structured in a particular way. The upside of an MBO over an EOT is the ownership, and that's what we're going to be talking about on the left-hand side. You see, those of you who are really paying attention to what we were saying earlier, it's the trust that owns the shares, not the employees. And with an MBO, it is the go forward employees who then take ownership of those shares. So they get the capital growth. Yes, they've got a fund part of it. Yes, there are other challenges, but with an MBO, they have actual equitable interest and therefore ownership of those shares. So because the employees are saying, well, hang on, wait a minute. Yes, I'm a beneficiary of this trust and I've got some sort of interest in the shares. I'm not going to pay income tax when I get any value out of this trust. That's not the same thing as owning shares in a company where I might get capital gains, assuming, of course, our Chancellor doesn't raise the rate of capital gains tax to some eye-watering number later in this year, and do turn into our budget announcements on that. There are other alternatives, and we're not going to go into detail because this all gets a bit challenging and a bit tricky. But things like share schemes, things like growth shares, and certain types of reward structures can be used to balance this conversation, so that the go forward team feel that they've got and have in fact got an equitable interest in the business going forward. There's a lot. It's complicated, it's detailed, but it is very rewarding for everybody concerned if we can get that bit right. So we just want to touch on those going forward. An EOT isn't the end of the conversation. An EOT is part of how we slowly transition the business to the next generation, part of the succession planning for everybody.
So you can do those three things. Tom just talked about the share schemes, growth scheme, and other reward structures. You can do those, as we say on the slide, in addition to doing an EOT.
Indeed.
You can do those in anticipation of an EOT, or they can be an alternative to an EOT.
Right.
Depending on what you want to achieve with your business, because this is all about your business, not about our business, you can get variations on the theme. So we've all now sold the business. We've been to the pub, we've woken up the next day, and who should we actually start talking to? Tom?
Right, so post-completion, as advisors and lawyers and accountants and everything else, we get very excited and we run along with you, get the whole transaction done, and to some extent, we finish the transaction, we send you our bill, and that's the end of our sort of involvement in it. But it isn't really, because our involvement is to help and support you do this stuff, right? So we need to go through a checklist, the post-completion checklist. We need to deal with minority shareholders. We need to deal with option holders, right? Because they might be entitled to exercise their options because they might become minority shareholders. We need to deal with the bank and other lenders. We need to deal with the regulator. We need to deal with maybe talking to employees, engaging them again in the process. Because you may have had that conversation with them a year ago. It could take that long from the first moment you speak to your team all the way to the end of the transaction. There may be new people who've joined the business. You need to spend time with your people and explain what's happened and why, and what their benefits in it for them are. Always asking that question, what's in it for me, the why bit. Deal with key clients, deal with customers, and anyone who has any kind of like change of control provisions. You need to deal with all of this as part of the post completion checklist. And then the second part of all of that is you will need to contact loads of different people, right? Accountants, advisors, marketing people, the revenue. So never forget HMRC, they're always involved somewhere. Let them know that the trust has been set up and go through the trust registration service. Deal with the stamp office. If you've got a landlord, deal with them, company's house. And of course, finally, again, HMRC for the second time, we need to talk to them about the relief. So don't leave all of this until after completion. Make sure this is all part of the steps plan that's agreed in advance, and everyone's aware of who is doing what and when. A large part of these kind of transactions, any transaction, is getting that steps plan agreed in advance, all the way from start to finish, and ensuring that everybody who's supposed to be involved is involved, knows when they're going to be involved and what their responsibilities are, to never be forgotten. And more importantly, once it's done, go back to it, actually refer to it. It's very useful because then things don't get missed, one would hope.
And so we've put this together as a post-completion contact list, but please don't complete and then turn to this list and think, right, what have we got to do now? What you should be doing is you should have lined up pretty much all of those people that we've got on these two parts. And probably the only one you don't need to line up is the stamp office, because they'll happily take the money afterwards. But pretty much everyone else, think of that as a two-part process. Speak to them beforehand, informally, or more formally if you need their consent, and then speak to them afterwards. Take people along with you along the journey, and they will love the journey.
Yes.
If you dump it on them and announce it to them that this has happened, they will not love the journey as much.
Correct. So just before we get to the Q&A piece, just a very quick recap on the benefits. So seller, no tax. Okay, at all. Excellent news. So as long as everything works the way it's supposed to work, you as sellers do not have to pay any tax. And yes, you can still retain an interest in the business, both via a small number of shares in the company, because it is, after all, the thing you built, but also as trustee in the trust, so you can keep an eye on what's going on. For the go forward team, they will have ownership. They will feel like they're more connected to the business. They can be rewarded by a tax-free bonus when the cash is available, paid to them by the trust of $3,600 a year. Yes, there's national insurance, but it's better than have to pay income tax as well. And so there are some strong benefits. And what we have seen is our experience is that when EOTs are done properly and done well, and all of the engagements lined up in advance, and we do the hard yards, particularly before the transaction, engaging the team, that they have a massively positive effect on the people involved within the business. It really does help. It really does do what it is set out to do. It's one of those rare things in tax that there's a relief that actually works. It actually does the thing it sets out to do if it's done properly.
It is lovely to see clients that you acted for 3-4 years ago chat to them about this and say, we're so glad we did an EOT. We're so glad we did that transaction. The staff are fully on board, fully engaged. And also, bearing in mind, there's I hate the phrase, but there's the war on talent or the war for talent. You will find it easier to retain and recruit staff when you are an EOT, and your customers will either be neutral about this or will be positive in the main.
Yes, agreed. And the holders diagrams that we've thrown up before do look a little bit scary, I think, for some people. But actually, once it's in place, it's really easy to work as well. It doesn't change or frustrate the business. It actually makes it better, because you've got so many more people who are actually engaged in what the business is trying to achieve. And that's a very positive thing. So with all that said, Q&A. Do we have any questions?
We have a lot of questions.
Oh, good. That's good, because otherwise Tom and I are going to have to make up questions for each other. Right. So we've got someone in the room reading out questions for us. So
can the founders also be members of your EOT?
John? Generally, the answer is no. The founders will be excluded because they will have, I suspect, in that picture, they will have 50% of the original company. And so they will not be able to benefit from the bonuses of the EOT. So no is the answer.
Who typically borrows the money? Is it the EOT or companies?
The company. So the company will borrow the cash, and to be fair, if you're the lender, you're going to want to lend money to the entity that has the assets, i.e. the business.
Is there a minimum level of cash the revenue needs the holding company to have on the balance sheet prior to a sale to an EOT?
Not that I'm aware of.
I think that means, is there a minimum amount of cash, which would mean it was an investment company?
Oh, yeah. Look, I mean, if that's the question, then no, not really. I think every company carries cash for different reasons. Working capital. You know, if you're like we both are, we're professional service firms. We have to carry a certain level of cash in order to ensure that we don't go bust and we can pay all our people, which is our largest cost. Other businesses, they carry even more cash because they have certain credit terms, or they have to burn a lot of money on R&D. And some businesses carry very little cash, simply because they are very much, they go to the market, they buy the food that they then turn into, great grub for their customers in the evening, and it just goes round and round in circles. So in the restaurant trade, so there isn't really an answer to that. But if you've got excess cash, if there's cash on the balance sheet, if we're investing that is with a broker, that kind of thing, then there's something we'll probably need to consider.
Who decides the composition of the board / trustees of the EOT, especially when they have significant debt to the founders?
That would be set up on day one. The rules are now that the founders can't be in control of that. So you would set it up on day one. So in my story, you would have the one founder, you would have two independent advisors, so you would have the three, and effectively those three would then continue to run that and monitor that going forward. I'm not a big fan of an employee council on day one. I think if you are going to have something like an employee council which can nominate one of those independent trustees, I think that's one for a wee bit down the line, maybe once the loan notes have been repaid off.
Do EOTs, by their nature, find making decisions such as making employees redundant difficult?
No. The EOT is not in charge. That's actually very good questions. Very astute. The EOT is not in charge of running the business. The holding company and those three subsidiaries we talked about, they will still have managing directors, they'll have finance directors, they'll have marketing directors. Those people are in charge of, and HR directors, those people are in charge beforehand and then afterwards of running the business. And in that sense, nothing changes there.
We've got 17 there. Are there any rules regarding the number of shareholders of the holding company? And do shareholders have to be founders? I think you covered that.
No and no.
We just use founders because it's easier. Yeah. If we've got 17 questions, we'll try and speed up. Here we go.
Is there a minimum number of employees in the company? I'm thinking of it if the EOT might be suitable for a small company.
It's participation fractions, which is important, and of course, if it's a one-man band style company, then the EOT can't work. But there's no set minimum other than this fractional thing that's worked out.
If you broadly, and this is an oversimplification, if you think you've got to have more than double the number of employees as there are founders, then you're doing okay.
That's the way to put it. Yeah.
What sort of industries are EOTs most common?
Oh, that's a great question. Architects were the original
surveyors.
Surveyors, yes. They jumped in.
Law firms.
Yes.
Basically, it's not any industry where the people matter. So I have to say, it's very rare for us these days to sell a business where the people don't matter. Every business we sell to an EOT or anything else, the people are at the core of what they do. So absolutely everything. You can, there's some extra traps. You can even sell a GP practice to an EOT. So if it's owned by individuals, you can pretty much sell it to an EOT.
Is the employee bonus paid while debts to the founders / sellers remains outstanding?
It can be, but it's not all that common.
It's not mandatory, but what I think is really important is you find a way to get some sort of bonus to the staff in the early years.
Yes.
Even if it's just £100, it shows them that this thing actually works. So leave a little bit of cash behind on the table to pay that bonus.
How do you recommend making it real and meaningful for the beneficiaries when the primary focus may be paying the loan notes off over a number of years?
And this is part of the additional things that we put together. So often share schemes, growth shares, those kind of things that we use inside modern reward structures. So you would turn around to your key team, people you want to make sure are still there going forward, and give them additional interest in the company through options over particular types of classes of shares, which entitle them to future growth in the value of the business.
It's not an instant thing for the staff. But we talked about 10 million and $1 million a year. You say to the staff, we've agreed that it's going to be $1 million a year. If you can drive profits so there's excess cash of 1.1, then that extra 100,000 will be subject to agreement at the time, will be distributed out to the staff. So you make the profits more, you get more. It's direct correlation.
Absolutely right. In the same way that you would structure any business, even if you weren't doing the EOT, to be honest, how do you motivate and incentivize people within the business?
Do the trustees, the sellers, and the company have to be separately advised?
No. Sometimes they are, sometimes they're not, but not as a matter of law. They don't all need to be separately advised. But that's a nuanced question.
Yeah. On the valuation point, I think it's often important that you have one valuation, and that's presented to both the trustees and the or the would-be trustees and the sellers for discussion. But I think if you've got a complex business, or you've got a business whereby there's the go-forward team are perhaps taking on a very large liability, it's probably quite sensible for them to get advice as to how they approach that. It doesn't necessarily have to be a different firm that advises them, but it's probably quite sensible for them to get advice specifically on their point.
It's about managing the sale and purchase agreement, making sure you've got the right level of warranties and indemnities as regards the nature of the business being passed to the founder, to the EOT.
And in that circumstance, if there is, it probably is worth considering at least having somebody else involved.
And let's do one more question.
Yeah, okay, that's good because we've got
60 seconds.
Yes. And there have been a couple of questions on this, so let's do this. What are the likely professional costs for a £10 million EOT sale?
You have to choose that one.
But there have been a couple of them.
Here we go. Right. A lot of this, I'm going to say depends, then I'm going to come up with a number at the end. A lot of this depends upon how many founders you've got, whether you're selling 100%, because if you're selling 100%, then you don't need a shareholders agreement. But I would always recommend you sell less than 100%, because everyone always wants to retain that emotional interest. So you need to have the shareholders agreement, you need to have the loan notes, and you need to have all of that. If looking back to the previous question, if it's agreed that the EOT is not being separately advised, then Tom may hate me for this. We would go more refined on any detail, but I think for less than £10 million, bearing in mind there's no corporate finance fee, I think you'd end up with a fee of double digit in the thousands, but towards the top of that rather than the bottom. So I would have thought you'll end up somewhere in the range of £60,000 to £100,000 for your whole range,
all in. And I think that's probably that's usually where we see the market. But that's not atypical from any kind of transaction. So even if you were selling to a trade buyer, the total cost of the legals and the account and tax work is probably going to be not too dissimilar. Probably
comes in a little bit cheaper on the legal side if you're selling to an EOT, even though there's more documents. If you go with a sensible first cut of everything, which is middle of the road, should be acceptable to everybody, then you can get a fixed fee within that range, and that range, I didn't say it was plus VAT.
But bearing in mind, of course, that the sellers aren't paying any tax whatsoever. So there is that does, of course, soften the blow of the cost of the transaction.
And as regards VAT, some of the fees can be addressed to the target company. But not all of them.
Indeed.
We have to work out as advisors who we're actually acting for. If we are setting up a share scheme for the company, we can build a company. If we are advising the founders as regards how they claim tax relief, we have to advise the founders.
We do. So everybody, thank you so much for those questions. The ones that we didn't get to, we apologise. We've run out of time, which is a nice thing. It's a good thing. Everyone's been paying attention, which is great. We'll try and get back to you on those questions over the course of the next couple of days. We hope you've enjoyed it. We hope you've enjoyed this morning. We certainly have, because John and I get on and it's quite nice to just have a chat. If you have any questions or you want to reach out and discuss anything, EOTs or anything else, tax related, legal related, or council, whatever, then those are our details on the screen. Again, thank you very much for coming along. And and note the disclaimer in the bottom left-hand corner. Now, this is advice.
And we send these slides round.
We will.
Yeah, so send them round. Okay.
Brilliant. Thank you, everyone. Have a great day.